So raise your hand if you're seeing a financial planning topic, real estate investment, sale of property. Thank you, everybody. So if you're just joining us on YouTube, please be sure to hit the subscribe, like, and notification button. And this is the financial planning topic of our Tuesday weekly webinar. Last week, we talked about how a real estate portfolio fits into your investment portfolio. And I've been a real estate investor for a long time. I believe that it can work really good in a as first of all, I don't want to get into it too much and repeat what I said last week, but it is a non-correlated asset to stocks, bonds, and cash. So it tends to operate well when the stock market might be lagging. That's not always the case. So it is a good component, or can be a good component depending on your situation for your investment portfolio. But today we're going to be talking about what if you own property now, whether they're rental properties, and we're really talking about investment properties here. And now it's time for sale. Well, first of all, you should be planning for this sale. So really, you should have a plan for sale at purchase. So at your purchase, you want to have an idea. Now, it's likely that what you plan for from something you purchased 20 years ago and how you end up liquidating it or transferring it might be completely different. But you should have it in your mind that, hey, I'm either going to liquidate this at some point, right? And whatever that point might be, it might be retirement. It might be that you want this for your income in retirement, and you're not going to, and maybe you liquidate it if you need long-term care, or it might just be part of your estate plan. But of course, have some kind of plan for that property and that sale, because timing is very important when it comes to real estate, because real estate is a very illiquid market at different times. So things have been hot for the past 3 years, and there have been plenty of opportunities to sell most properties depending on their location, their the type of property. But there have been certainly times in our past when it's been very, very difficult to get to sell a property, and you might end up selling it at a discount. Yeah, it's happened to me. So you have to be aware of your timing and liquidity, and of course, you've got to be aware of tax. So this real estate can be a very tax beneficial investment. There are components to real estate that allow you to have some tax benefits that stocks, bonds, and cash just do not. But when it comes to the sale of the property, you can get caught up in a tax situation that you just might not be ready for. And once it's done, you can't go back and undo it. So there has to be good planning around that. And that takes us back, as always, to your team. So remember this team that you want to put together. You want a good certified financial planner on your team, or a team of certified financial planners, and you want them qualified in your area that you're focusing on. So, I do have a bias towards certified financial planners when you're talking about financial advisors, because that is there's a lot of education to obtain that certification, and there is a comprehensive exam that you have to pass, and only 50 to 60% of the people who take that exam pass. So if, out of the hundreds of thousands of financial advisors or financial planners in the country, why wouldn't you deal with somebody who's really worked to achieve the most coveted designation in the industry? You're also going to want a CPA on your team. Again, I think your accountant should be a CPA for all the reasons that I think your financial advisor should be a CFP. And then you want a good attorney on your team. Now, I often talk about the estate planning attorney, estate and elder law attorney on your team. But if you're a real estate investor, well, you're going to want a real estate attorney on your team, because it's likely that this individual here isn't really going to be as knowledgeable in real estate as you're going to want. So you might end up with, you might have one attorney. If you have a business, you might have a business attorney. You might end up with 3 or 4 attorneys on your team, but you want people who specialize in the areas you need them for. You don't want a generalist. You do not want the person who can draft your will. This is just my opinion. Draft your will, help you with your elder law cares. By the way, help you with real estate. And if you get a ticket, they can help you with that. And if you know somebody who had a slip and fall, they can help you with that as well. That is not the situation that you want. So you want to develop your team, and you want to have that team in place as part of your planning process. You don't want to be compiling these people while, when you have a liquidity event, like a sale of a real estate, or God forbid, a long-term care event. You want these people to know you, know your family, know your business, and to be able to help. And everybody should be working together towards the same goal for you. So have your team in place. So of course, the benefit of real estate is not only income, right? So you can have really great income throughout the ownership. We talked about the tax benefits as well. But increase in value. So, if I buy a property today for $1 million, I certainly hope that, let's see, the math would tell us in about 12 years, that would be worth $2 million. So let's just use that. That's an increase in value. And I swear that says $1 million. I know that's a little messy, but you want that increase in value. Now, let's just say in 10 years, I want to sell that property. Well, the difference between the $1 million and the $2 million, the IRS is going to want their piece of that. And how they get their piece, or if they get their piece, or when they get their piece, is really important here. And there are really some good tools that you can use, but some rules that you have to pay attention to. So the majority of this growth should be in the form of capital gains. So again, you can go to my website. I'll pull this back down. I've got the tax chart right here because I use it all the time. And we're talking here about these capital, it's not letting me draw on here, right over here on the right here. I hope you can see that. These, I'll move my cursor over here, these capital gains rates. So ideally, the majority of these funds at growth, $1 million to $2 million, is going to be based in capital gains. And the most that you'll be capped out, really, it could be 25% with real estate, but you're looking at 20% plus the 3.8 Medicare surtax. So the most that you'd pay on the growth of that, depending on your income, is 23.8%. Many, and most people probably fall to the 15% capital gains rate. You could, of course, do 0 if your growth and your income is low enough. But that's better usually for folks, these capital gains rates, than these marginal income tax rates on your left. So that's why you'll often hear about this as the preferential tax rate of capital gains. So, even if you come in at full boat 23.8, for that $1 million in growth, that of course is much better than 37% if that was all ordinary income over here on the left. So that's why people talk about the preferential capital gains. But there are ways to avoid that, at least in the short term. So let me figure out how to get me back over here. Move that out of the way. But I'll come back to that, because you have to also be aware of depreciation recapture. So depreciation recapture is something that the IRS, they're keen on making sure they get all their tax. And as you own properties, there is a tax benefit called depreciation. So there are 2 different schedules. The most common one depreciates your assets over a 27.5-year period. But you get to take a certain percentage every year, and you can even offset income with that. So depreciation really is a writing off of your original purchase price, any costs that you have with that, any updates, things like that. So what happens is that if you sell it prior to that lifespan of that property, then the IRS has this depreciation recapture. So for instance, if in this example, and I'm just making this up, if $200,000 of this $200,000 of this $2 million is depreciation recapture, then this doesn't have a chance to be taxed as capital gains. This is going to be taxed as ordinary income, as it shows here, and that's going to fall into that marginal tax bracket. And you could be taxed at 24% under the current rules, 32%, 34, 37%, right? So it just depends. I'm sorry, 35. I thought, yeah, 35, 30, you could fall in 24, 32, 35, or 37%, wherever you happen to land, depending on your other income. So that $200,000, if it's part of the depreciation recapture, is going to be subject to ordinary income. So you again, part of your planning, be aware of that, because if you thought, well, hey, wait a minute, if all this is taxed at 15%, that's pretty good, even if it was at 18.3 with the Affordable Care Act surcharge. You might say, well, that's better than my ordinary income tax rate. I'm at 24. And then suddenly you have to account for 200,000 going into your ordinary income, just like we talk about other things. Here is your graduated cylinder for your tax rate, starts at 10, goes to 37 currently. That $200,000 will flow right into here, and it will, this is how you determine your marginal tax rate or your effective tax rate, but it's going to affect all of your income, right? It's going to fill up with all of your income there. So don't be surprised about that. Know what that dividend recapture is. But there is a way to not avoid it, but put this off. And that is, you may hear this if you're a real estate investor, or maybe you've read about it. There's a thing called a 1031 exchange. 1031 exchanges can be really, really beneficial. It is just replacing, let's just make this simple. You've got building number 1 over here. Building 1. You want to sell that, and here's our $2 million sale, and we bought it for $1 million. So in some shape or form, we owe $1 million in tax, whether it's capital gains, all of it, or ordinary income. Well, the IRS says, well, if you want to stay in the real estate game, you can identify a real estate property, and we'll call it building number 2. And they'll allow you to do a like kind exchange. And in this example, it's called a 1031 exchange, referred to as 1031 exchange. 1031 is the IRS code that it falls under. And this allows you to buy a like kind building. And those rules are, I'm not going to get into them, because you really want to work with someone who's very knowledgeable about this. You need a third party person to hold the funds in escrow while you're identifying a property and closing on the property. But you can pass these gains right over to this building number 2. And then you end up with $2 million here that is passed through. Now, here is an example of some of the requirements. Now take a look at this. I put these all in notes as I was going through. And this is still just an overview. So 1031s are very complex. It's not something that's insurmountable. It's something you should certainly look at if you have an interest in that. I had a conversation one day with a friend of mine who does some real estate investing, and he sold a property in the Poconos, and then they bought a property down the shore. And I said, did you do a 1031 exchange? And he said, no, I never heard of that. And that really stinks, because the property they bought in the Poconos was, they had bought it very cheaply. They made quite a bit of money on it. They had to pay capital gains and ordinary income on some of the depreciation. So sent the tax money to the IRS and then bought another property down at the Jersey Shore. But what they could have done is taken that, done this. You have to identify the property within 45 days. And you have to close on the property within 180 days. So these days run concurrent. So you got to be very, very careful about that. And the funds have to stay in escrow. They have to stay with an escrow company. They cannot go into your bank account in the meantime. You can't profit, you can't have control of those funds during that time. But it can be a really nice way to pass on that tax liability. But what if you say, you know what, I've been investing in real estate. It's hard to find, because the truth is, it's hard to find good property managers. It's a pain in the neck to have tenants sometimes. So there are a lot of headaches. It's not easy. It's not for the faint of heart. You've got multiple roofs, you got multiple heating systems. The more you expand your portfolio, the more things are at risk of breaking, and winter's coming up here. And I always have to think about clearing parking lots and streets and all that crazy stuff. But there are things involved, and you might say, you know what, I want to be out of this game, but I really don't want to pay tax on that $1 million yet. Well, there is a structure out there, and that's called we refer to them as DSTs, or Delaware Statutory Trusts. So a Delaware Statutory Trust, again, much more complicated than just for this discussion, but a Delaware Statutory Trust allows you to 1031 exchange. So you don't pay any capital gains. You defer your capital gains and potential ordinary income into this Delaware Statutory Trust program. Someone else manages the properties. Delaware has very different rules than any other state in the country. As far as I know, Delaware is the only state that allows the incorporation rules that they have. And you don't have to be in Delaware. You can set up a Delaware corporation and be anywhere in the country. You want to check with your attorney about these things, though. But a Delaware Statutory Trust allows you to invest in real estate in more of a hands-off feature. So of course you're going to pay fees to people, and you have to make sure that works, but it allows you to have this 1031 exchange process completed for you into a Delaware Statutory Trust. Still have the benefits of real estate ownership. There is income that comes off of these. So any income that is generated has to be distributed. There, of course, can be growth of the holdings, but it's more of a hands-off. We talked last week about real estate investment trust. You can't 1031 exchange into a real estate investment trust. So a Delaware Statutory Trust is kind of like that, but they allow you to do these 1031 exchanges into something that's much, much more passive than owning the property yourself. These are very, very interesting. There's been a big uptick of interest over the past several years. I'm not recommending that people use them, but if you're a real estate investor, it should be something that you're aware of. So I see a question. I'll take that question. John asks, if a person is depreciating their investment property, should that person keep record of the amount they have depreciated every year? So when they sell the property, the depreciation, they know the depreciation recovery amount. Absolutely, John. So again, record keeping is on you. This is why you should have your team. You should have your accountant helping you with that and keeping those records that he or she produces for you. But if the question becomes between you and the IRS, what the dividend or the depreciation recapture is, it's probably not going to be in your favor. So you want to have those records, and again, so you can plan, because if without those records, you're just taking a shot in the dark, and those shots in the dark usually don't end well. I don't know the statistics as far as the IRS looking at these, but I'm willing to bet that it's high up there. So good question, John. Thank you. All right, so we've got plan for your liquidation. Know what your tax burden is going to be from that liquidation. And it might just be that you're okay. We're just going to liquidate it. We're going to, if we have $1 million of growth and we end up with $700,000 in proceeds, I'm okay with that. Or you might say, I want to defer that into a building or a property. Doesn't have to be a building. I was just using an example. That I manage, I continue to manage, and maybe it's more income, maybe it's just a better situation or closer location, warmer location, whatever works for you. But no, if you're going to do that, you've got some requirements. You can't possess the money. You have to use an escrow. You have to identify a property in 45 days, and you have to settle on that property within 180 days. And this can be done in reverse. You can buy your property first. You're set building number 2 first, and sell your building number one and still be able to do the 1031 exchange, but you still have to follow these rules: 45 days for identifying the property, 180 days before close. At the close within 180 days. Now, the other option is you might say, you know what, this property has appreciated quite a bit. I've gotten a lot of income from it. I've had some tax benefits. I don't want to sell it. I want to pass it to my heirs. So, there is estate planning potential here. And under the current laws, you could defer paying tax, either using one of these two or both of these strategies, 1031 exchange, or just keep the original building. And right now, the way that the federal estate tax structure is set up, your heirs would receive the properties at a stepped up basis. So what is stepped up basis? Well, it's very simple, folks. Here's the real estate. Let's get away from the building so you don't think it's just buildings. You bought the property for $1 million. It's now appreciated to $2 million. And then you pass away. Now, under the current rules, your heirs, so $1 million is roughly, I know there's other things that go into the basis, but let's just say this is your basis. If you gifted this, or if you sold, that's cost basis. And yes, if you have maintenance, if you have things like that go into it, it's going to increase the basis. But let's just use $1 million to keep things easy. This is your cost basis. So now, while you're alive, if you sell the property, this is what it's going to be based on: your profit or loss, and of course the depreciation recapture that we talked about. Now, when you're no longer here and it passes to your heirs, this $2 million is their new basis. Because it is stepped up, or it's really step two, what it is on the date of death. So it is possible to acquire real estate, have significant growth in real estate or traditional investment assets other than IRAs. IRAs don't carry the cost stepped up basis. Any investment like that will not retirement accounts will have that stepped up basis. So it is possible to have this growth in this real estate, have it grow significantly. You have all the benefits. And then when you're no longer here, it could pass to your heirs tax-free. And then they have to worry about unraveling it, what the market is, and their timing and their planning and all of that. And you might have some requirements that they keep the properties or sell the properties. That's all part of it. My original will, when I was first married, had a requirement that if we owned properties when we passed, that my kids weren't allowed to liquidate them until I think 10 years later or something like that. My thought was I wanted them to learn the value of owning properties and managing tenants and things like that. What I learned over time is what I enjoy, and when I learn what I benefit from may not be what my kids enjoy and benefit from. So I removed that in my current update to my estate plan. I just share that with you because there's all different things that you can do with that. So we have another follow-up question here. Does depreciated amount also get stepped up like the appreciated amount? John, I'd had to think that through. That's a good question. If you send that to me in an email, I'll get back to you. But another great question. Okay, folks, so we're right on time, 10:45. I hope that was helpful. I'm going to stop my share here. I hope that was helpful. I look forward to seeing you all next week. And I hope you have a good holiday week, Thanksgiving week. If you need us for anything, reach out to us. Please complete the survey at the end of the webinar. If you want to schedule time to talk to me and you're not a client yet, you can go onto our website and click the link on there to schedule time. If you're a client, you've got our links, or just call into the office and we'll see you right away. Thanks, everybody. Have a great day. Enjoy the rest of your week as well. Take care.